Welcome to today's deep dive. So for you listening today, our mission is to figure out exactly why the digital asset market on this specific day, April 15th, 2026, is basically trapped in this massive structural vice. We're looking at a market pinned between a really stubborn macroeconomic wall and, well, a tightly coiled algorithmic spring.
Right. It is a fascinating collision of forces, and since we know you already followed the space, we're keeping a strictly analytical tone today. We're just skipping the basic background concepts and diving straight into the institutional mechanics that are actually driving this friction.
Yeah, let's start with that unmoving wall. I mean, the March 2026 Producer Price Index, the PPI, is rigidly stuck at 4.0% year over year. But the why is what's so interesting here.
Exactly. It's driven almost entirely by the physical world just breaking down. We're seeing a massive 42% spike in wholesale diesel.
Wow, 42%.
Yeah, which is directly caused by global maritime shipping bottlenecks, just incredible physical friction.
Right, so ships can't move efficiently, diesel prices skyrocket, and that keeps inflation sticky, which means the Federal Reserve has, absolutely zero justification to cut rates. The market is starved of cheap money.
Completely starved. And because that inflation data kills any hope of macro fiat flowing in, price discovery right now is being dictated entirely by internal market mechanics. Specifically, we've seen 46 consecutive days of negative funding in the derivatives market.
Wait, 46 days? Okay, let's break that down for a second, because that duration is wild. Negative funding basically means the market is so heavily skewed towards short sellers betting the price will drop that they actually have to pay a fee to the long buyers just to keep their positions open. It's like stretching a rubber band to its absolute limit.
Precisely. They are paying for the privilege of betting against the market. And what's predictive here is that this specific 46-day duration exactly mirrors the absolute bottom of the late 2022 bear market. Eventually, the rubber band snaps.
Which we literally just saw happen. A massive $527 million liquidation flush.
Right? All those trapped short sellers were mathematically forced to buy back in, which drove the price up.
But here's the real insight for you. Despite that massive, volatile deleveraging event and the restrictive macro environment keeping new money out, the spot price didn't collapse before the squeeze. It actually built this really solid consolidation floor near $73,700.
Yeah, because institutional infrastructure is acting as a giant shock absorber now. You've got Morgan Stanley's new spot ETF MFPT.
Oh, right, the debut week data.
Exactly. It absorbed $84 million in its debut week alone, anchoring the spot market.
It does anchor it, but, well, hold on. I need to stop and ask a fundamental question here. When I look at the other side of this infrastructure, the miners, our traditional miners, even crypto companies at this point.
That's a very fair challenge, especially post-halving when their profit margins got compressed so tightly. I mean, they've been forced to evolve.
Right. Look at enterprise miners like BitDeer. They aren't just mining anymore. They've pivoted hard into AI. They're hitting $43 million in annualized revenue just by renting out over 2,000 advanced GPUs for high-performance computing.
They basically realize they have massive amounts of electricity and cooling ready to go. So instead of just mining and hoping the price goes up.
Which usually forces them to sell during bear markets to keep the lights on.
Exactly. Instead of doing that, they rent out that computational power to AI companies. That revenue completely subsidizes their crypto operations, meaning they don't have to dump assets onto the open market.
Okay, so the institutional side, the Wall Street ETFs, the AI-subsidized mining data centers, that infrastructure is maturing and stabilizing the market. But man, that stability really highlights exactly what's going wrong in the unregulated corners of the space.
You're talking about the DeFi sector.
Yeah, the localized contagion happening right now. Look at what just happened with World Liberty Financial, or WLFI. Their token plunged 76% in hours.
And the mechanism there is what's crazy. WLFI sold itself as decentralized, meaning nobody is pulling the strings. But blockchain forensics exposed a backdoor blacklisting function in their code.
Right. Administrators secretly retain the unilateral authority to freeze anyone's assets at will without any community vote whatsoever.
The moment the market realized the decentralization was a total facade, everyone scrambled for the exits. It triggered such severe capital flight that their flagship stablecoin briefly lost its dollar peg.
Which entirely explains why Treasury Secretary Scott Bessent is effectively kicking down doors in Washington today. I mean, he's publicly calling holdout crypto executives nihilists.
Nihilists, yeah. And he's demanding the immediate passage of the Clarity Act. The Treasury's doing the math, and the stakes are absolute here.
Sure.
If they don't establish clear jurisdictional rules right now, they are modeling a $3 trillion capital flight.
$3 trillion going straight to places with highly regulated, welcoming environments like Abu Dhabi and Singapore.
Yes.
So, what does this all mean for you listening today? The digital asset ecosystem is absolutely starved of cheap macroeconomic liquidity, but it is being structurally reinforced from the inside out by AI-subsidized miners, steady net long ETF inflows, and a mathematically squeezed derivatives market.
It's a market that has learned how to consolidate and build a floor while under immense competing pressures.
Which leaves us with a final thought for you to chew on. Think back to those enterprise miners renting out their GPUs. If enterprise artificial intelligence computing is now actively paying the electric bills that secure the digital ledger, are we watching the permanent, irreversible convergence of global AI hardware and cryptographic infrastructure?